So the purpose of this video is to create a more enjoyable, seamless policy review experience. So I'm not sure, it's, speaking to you directly, Josh, and if by chance, Melissa, that you're listening to this, or Myles, which I hope that you will show this to Myles also. But for anyone that has not had an experience in dealing with these types of things, then if it's term life insurance, which is one that has a definite end time, it doesn't build cash value, there's not a lot of bells and whistles to it, then there's really no policy review that's needed. It doesn't change, like either it's active or it's not. That's not required. If it's a whole life policy, then it's a case where it's really not a lot of policy review information that needs to be had. You can review time to time to see the cash value that's available there. If the individual is not looking to buy any more life insurance, then there's not a lot to talk about. So that's not really a concern. But when it comes down to in universal life insurance specifically, this is something that is very unique. And I'm still working through the process of making it as seamless as possible. It can be a very, very complicated product, which can be good in a lot of ways because it's a lot of benefits that you could access. The bad or the downside is that it could be very complicated. It's a lot to it. So that if we don't understand what's going on, then we just forfeit the opportunities and the benefits that are available with universal life insurance. So that's one side of it. The other side of it is what it takes to actually get it. Everybody can't get this policy. And you guys are finding out through the process as far as the underwriting process that it could be a little bit tricky, and they may ask some questions and get up in your business, but it's because it's a contract between you and the life insurance company. It's a written contract with all the details, and they have to hold to that. So if they say they're going to do it, they have to do it legally, right? And they have to be able to hold their end of the bargain. So they're not taking on everybody. They're not taking on every risk, right? They may say no now, but yes later, or no and no to ever, right? Never for some people, just because the risk doesn't make sense to them. And it's not just medical. It could be also financial risk. It could be lifestyle risk, like all those types of things. And if you don't know this, then the life insurance companies are in the business of making money, right? That's what they do. They're not in the business of providing death benefits. That's not true. Their business is to take the premiums that you guys are providing or we're providing as policy holders, and they're going to take that money and make more money. That's it, right? That's the real business that they're in. And when we just come to grips with that reality, then we're able to be okay with the process. Okay, so with that being said, what we want to do is just hit on a couple things. The document that you receive as far as the policy itself is about 40 pages, I think, or longer, right? The whole package is like 80 pages or something like that, maybe longer than that. That's not going to be something we're going to go through all in detail. So what I'm asking is that as we go through this, if you formulate questions that you know that you have, make note of those, and you're going to reach out to me either by text or email, phone call, right? And let's schedule a time to get those questions answered, right, as quickly as possible. It could be just a case where I respond back if you want me to respond back in the way that you actually asked the question, or if you would like a face-to-face meeting, or if you would like to have a phone conversation, let's do it. But I want to make sure I'm very mindful of your time, the things that you want to do. And it's just a case where if I record this video, you can listen to this 24 hours a day, and you can listen multiple times if you choose to. And I believe that is a better respect of your time, right? And I want to make sure I do that. So with that being said, the way that we're actually going to do this, I have a presentation that I actually put together. Based on the presentation that I actually put together, then it's going to cover a number of things. Okay, so there are going to be a number of things that will be covered in the presentation, but there will be some things that are not covered. Okay, so there's no way that I'm going to be able to get into everything in detail. So I'm going to cover what I believe needs to be covered in this presentation. And then what I'm going to do is I'm going to go in after that, and they're going to actually pull up the policy that we have as far as Myles's policy. And then I'm going to tap on or touch on or highlight a few points so you can see the specific numbers that are unique to you. Okay. And then after that, then you'll have what you need to be able to decide what questions that you may have. Okay. So with that being said, then let me make sure that I'm ready to do this. Okay. And the storehouse of wealth is a concept. Okay. It is not the life insurance policy. So based on the way that I view the potential of the universal life insurance policy or a dividend paying life insurance policy, either or, but in this case, we're talking about an index universal life insurance policy, then I see it as an active investment account as far as the highest potential for it. But I have to be very honest with myself to understand that not everybody shares that same goal. So no matter what your goal is and the reason why you wanted to put this in place, then it can do that. It's going to exceed what you wanted to do, as long as you know what your goals are and what you wanted to do. So with that being said, then the storehouse of wealth is my concept and my approach, the way I view life insurance as far as this life insurance policy. Why? I told you that the life insurance company is in the business of making money. Okay. As soon as we come to grips with that, we'll be better off. And the reason why is, if their business is to take your money and go make money, then I believe that it should be your business to take your money and also go make money. Does that make sense? Okay. So instead of it being locked away in a place where you can't use your money, and someone else is making money, right? And either not giving you anything or giving you just pennies on the dollar for it, then we're saying no. Okay, I know that the life insurance company is making money. Hey, let me make sure I'm getting in on the game, and I want to make sure that I'm making as much money out of my money, right, as they are, right, over the lifetime of the policy. And that's what this storehouse of wealth concept is really all about. So getting into that, what I want to do is just break down a few things. Again, this goal of this is to be a policy review. Okay, just to go back and rehash a couple things. Okay, after we've already done the paperwork, policy's been issued, these are the things I believe are very important to make sure that you know. Okay. So with that being said, there should be a number of questions. Okay. And when we're looking at this, I said that everything is in competition for your money and attention for that money all year long. Like, so your kids, right? Your expenses, your bills, your house, your car, everything is in competition for this same money, same dollar. And among all the financial accounts and options that are available to you, I'm asking, why should you want that money or those resources to go into an index universal life insurance policy, right? With all the competition that you have for your money, then why should this be a place that you want to put some of that money? Okay, so that's what we're going to look at today. So this account does have a tax death benefit payout. That's the reality of it. It is a life insurance policy, but what I want to do is be able to help to be able to expand that out more. And I know that Josh, during our conversations over the years, I believe you have a really good grasp of what it is that I believe this policy really should be used for. So it may not be new to you, but it could be new to Melissa, right? It could be new to Myles, and being able to allow them to have the time to be able to grasp that the death benefit is more or less just it's icing, right? There's more cake, right? But there's that may be just the icing on top of the cake. So what we want to do is stop having such a focus on the icing and really get down to the cake and how it's put together and why it is so good. Okay. So with that being said, then there's a lot of potential, right? One being that there's cash value that can build inside the policy. Okay. It has this accumulation power, and we'll look at some of that. Okay. What I'm asking is that as we're going through this, that you involve your family. And I know there's other kids that don't have this type of program, right? And they don't have to have it, but it's nice to let them know what's going on with you, what's going on, what you're doing with your finances to an extent, right? Maybe you don't want to share all the intricate details, but I myself wasn't involved with any of those types of things growing up, right? And what I found is that for wealthy and rich people is that they get their kids involved super early, right? And they have these deep, really good conversations about money in a healthy way, not just about paying bills, but in a healthy way. So I'm encouraging that you consider to involve your family. I encourage you to take this policy review, right? Go through it in detail, right? Maybe it takes you a few days, right? But actually go through it line by line, because it's a contract. Okay, it's a contract between you and the life insurance company, and you want to know how to hold them accountable for what they said they're going to do, right? Because they're going to hold you accountable. So if you don't do something that you were supposed to do in your contract, they're going to hold you to it. One of those things being is that most people don't know this. Is something I had to find out a few years ago in the hard way. Whenever a policy is actually issued, any life insurance policy, no matter what the life insurance policy is, that if something happens within the first 24 months, the first 2 years of that policy, now the life insurance company can go back and do a full underwriting. So even if they didn't do full underwriting, now they have the right to go back now, pay the expense and the time to do the full underwriting. So if the application shows that a person said no to something, medical wise or lifestyle wise, whatever it is, and they find out that that person should have at that time said yes, it will void the life insurance contract. I actually had that happen with a family. Okay. So again, if we're not accurate on the life insurance on the life insurance contract, even though they issued it, they're going to go back if something happens within those first 24 months. And this is in the contract. So again, they're going to hold you accountable for the contract. So I want to make sure that you're prepared to hold them accountable and hold them up to their end of the bargain. So it's many things that are in this, it's in this policy that you want to make sure that you're aware of. So if the time comes that you can actually utilize those things. Okay. So with that being said, just continuing on. So I've expressed this review time, or expressed it down to a few minutes. My goal is to get it down. I have no clue. Like this is my goal is to do 15-20 minutes, maybe get it down to a 30 or a 30 minutes, maybe, right? Even if I did 40 minutes, it would still be lightning fast, compared to what it could be. So, it's all good. It is what it is. But I want to make sure that you understand that I'm not going to cover everything in this conversation. Okay. It's going to be your responsibility to go in and look at this contract on your own. And if you have questions, then make sure you ask. And if there's something I know that you need to know, I'm monitoring it. If I know that there's something you need to know, then I'll try to do my best to get in contact with you. But I want to make sure that you are taking ownership of this contract. Okay. You are taking ownership of the opportunity that's been set before you. So I just want to make sure I'm doing this again, just making sure I don't know what you don't know. Right. So if I share it and you already know it, great. But if you don't know it, it's going to be a great opportunity to learn. But I'm asking, what is it, right? What type of life insurance is this? Okay. So this is universal life insurance. So if you think about it this way, for a person that knows what term life insurance is, term life insurance is like renting a house. Whole life insurance is like buying a house. Okay. So whole life insurance has cash value that can build. It's like a home that can build equity that you can borrow against or borrow on at some point. If you're renting a property, when you sell it, don't expect to have any proceeds, right? And you're not going to have any benefits outside of actually, living there in that house. You're not taking loans off or anything or nothing like that, right? So you have this term experience in life insurance and this whole life experience with life insurance. Well, imagine if they had a baby, right? And the funny thing is, if they had a baby, it would be universal life insurance. So what they did was they bridged some of the benefits of term and some of the benefits of whole life together. And more or less what it is, it's a renewable term life insurance policy with cash value benefits, right? So what they do is every year it incrementally could go up, because the more that the risk goes up, then the cost of insurance goes up. So as we get older, then it's going to cost the life insurance company a little bit more to be able to insure that individual. So it's a renewable term life insurance policy, but it has the benefit of being able to have cash value that builds. And you'll see why that's so important, and why that's so beneficial. So what I'm going to do is I'm going to pull up the actual contract and I'm going to show you this information. But again, for food for thought, then you want to know how much you're scheduled to pay. Okay, so how much are you scheduled to pay into this policy? And then for most people, the way that they normally decide to pay something into a policy is based on the death benefit purely, right? Death benefit purely. We're not doing that. We're basing it on a whole nother target. And our target is to be able to, based on the budget that you have set for your family, how can we maximize the use of that? How can we get the biggest bang for our buck for the amount that you've actually scheduled to pay? Okay, so that is one component that we'll look at. The other one is how much do we have to pay, right? So there's a scheduled amount that you're paying, but then there's a have to pay, right? That's the minimum amount to actually keep the policy in force, to make sure there's plenty of money for the cost of insurance to actually keep this thing running. Okay. So those are two numbers that we want to make sure that we look at individually and uniquely for you. But again, if you can just understand that these are two components of this type of policy, there's the minimum amount that you have to pay. Okay. And then there is the scheduled amount that you are agreeing to pay. And those are two different numbers. For some people that don't understand this concept, they can only pay the minimum, right? They don't have to pay more than that. They can only pay the minimum, but they're going to forfeit all the other benefits that are available inside this policy. Okay. So when we're looking at this term is called sub account. And I want you to see it and understand it, because this is where I believe it really gets exciting, at least for me, when I start to understand the potential of what this allows for a person and what it provides. So you see a picture there. I have two young men that are actually in a garden. So you imagine you are actually starting a garden, and that's what this life insurance policy is going to provide. And this sub account is going to be like your garden. Okay, so not everything that you pay to the life insurance policy is going to be planted into the garden, because some of it has to be eaten, right? It has to be used to actually keep everything in force. But for what it is that they do have of yours that they don't actually need, then what they're going to do is that they are actually going to take what they don't need to actually keep the life insurance policy in place as far as their expenses, and they're going to put it into something called a sub account. Okay, so with this sub account, that everything that's paid in above the minimum is going to go into that sub account. Again, imagine like a garden. Okay, so the goal of a garden is not to go back and get back what you put in. You actually want to get back more than what you put in. So you want it to have the potential to grow. So the difference is deposited into this sub account. Okay, so just remember that there's the minimum and then there's a scheduled amount. The difference between those two amounts is going into what's called the sub account. Okay, and that starts to build what's called cash value. Okay, so I'm asking you, why is this important, right? Why should you care about that? Okay, and what I'm saying to you is that 100% of the cash value stored up inside of the sub account is eligible to earn interest after the first anniversary date, right? That should be absolutely exciting when you think about that. Okay, so you're realizing that you're paying this premium, and you'll see the numbers is that you're paying this amount that's far greater than the minimum amount. And now you realize that a large percentage of what you're paying is actually going into the sub account. So you're looking at it and say, well, I thought I bought life insurance. You did, right? You did buy life insurance. But the reality is that between 80 and 90% of the premium that you're paying is actually going into the sub account and being planted into your garden so that it can increase in the future. I have the potential opportunity to increase in the future. That is an absolute phenomenal thing if you get that. Now, this thing, as far as how they determine or how it's determined, how it's credited, it's going to be determined by you, right? So there's a fixed amount that you could actually choose. Right now, I think it's about 4% or something like that. So that's a 4% annual percentage rate, APR. They credit not 4% per month, right? So the way it goes with APR is if you take 4% and you divide it by the number of months, right, or the number of days, depending on how often they credit it, then that gives you the actual interest rate that they're crediting. Okay, so in this case, I think 5% ends up being, I think it's like 0.884% or something like that per month. If you were to average that out, is what they would credit. So they would credit that every single month. Okay, now for this policy specifically, and most of the ones that I set up, then we are actually using a indexing strategy is what it's called. Okay, so it's mirrored to the stock market and the Standard and Poor and some other kind of matrix, but it's not there. The money's not actually there. Okay, and what we want to make sure we understand is that this sub account money is available. So there's a account that's set up to make sure it has enough to be able to pay for the cost of insurance. This sub account or secondary account, it is where the reserve is actually there waiting to be able to have interest credited. Okay, so when we're dealing with this type of policy, then after the first year, okay, it takes 1 year of funding. Okay, look at it as like a capitalization process. It takes 1 year in order for you to be able to be eligible to be able to have these credits. So they wait 12 months, and then whatever the money that's in these individual buckets. And I have another video. I'm not sure if I've showed you that video before, but I'll make sure that you get it. But imagine these 12 buckets, okay? And every month that you deposit money into your policy, then the money that's in there for January will go into January's bucket, February for February's bucket. So imagine 12 different buckets. So what happens is after the anniversary date, then they're going to look at that bucket, the amount of money that's in that bucket, if it's $100, $200, or $1 million, and then they're going to see what was the change in the market. If this is not the fixed rate, okay, if this is an indexing rate, they're going to see what the change in the market was, and if it went up, right, 20%, right? They have a cap. So the cap right now is 9.75, then you get 9.75 on the amount that's in that bucket. If it went down 30 or 40%, right, you're not losing anything. Your principal is protected, but you also wouldn't gain anything. So every single month, this is what they're doing. And on average, about what is it, 9 months, about 75% of the months over the course of the policy will be available, right? There'll be credits available to be able to add to this sub account. And that's a beautiful thing if you think about that. So it's not every month, right? It could be years like these past couple years where maybe it's 3 or 4 months, but it's going to make up and it'll average itself out, because there'll be a few years where there'll be a whole year where every single month the interest was credited, right? Or 2 years or 3 years, right, where interest is credited, but it balances itself out. And over the life of the policy, it'll be about 75% or 9 months out of the year that you should expect to, on average, be able to get credits. Okay, so I'll put this thing down here, this surrender charge, very important. Okay, so the surrender charge is what limits how much money that you can access. So in the case where the sub account is building money, you say, hey, I would like to access that money to do something I want to do with it. Well, what limits the amount of money that you can have access to within the first 10 years is based on this surrender charge. So the surrender charge is calculated, and then it begins to decrease every single year all the way down to the year number 10, and then it's zero and there's no surrender charge. So as long as the money that's inside your sub account exceeds the surrender charge, then you can actually access it. Okay, and we can talk about how you can access it, but the beauty is that you can access it. Okay, so that's one thing I have to be very upfront about. And I used to get a little upset about that, but now I realize, like, if it weren't for the surrender charge, many people would just take the money right out, go spend it for something, and then be pressed to try to pay it back, or the policy would lapse, right? Because they don't have enough money long term for it to be able to be sustained. So it really is a protection for you and for your future and for your goals, because the money will be accessible and it will be there when you really truly need it. It does make it so that, again, it protects us against our own self, our own habits, and things that maybe aren't an emergency that sometimes we want to believe they qualify to be an emergency. Okay, so just continuing on. And I mentioned that the sub account is credited, and the sub account is actually credited each month, okay, or has the opportunity to be credited each month after month number 12. So this policy is brand new, so it's going to take 12 months before this will actually be available to be able to have these credits that will be available. Okay, from then on, every single month they're going to calculate. They're going to go back to January of last year, look at January of this year, see did the market go up or down, and by what percentage, and then they credit the account for that month. They'll do that every single month after the 12th month. Okay, so it's just incredible. That's going to be a whole nother thing. I get excited about the anniversary date, because you'll see that you have more things that are available inside your policy that you can take a look at. That's exciting. The next date that I like is when you actually have your proceeds that exceed the surrender amount, and then you can see this amount that begins to accumulate that you can actually have access to use as you need it. Right? These are dates that you should get excited about, right? And they're coming down the line. So I said that you decide how this interest is credited. So they have all these different strategies that are inside the contract that you can decide which one you want to use. And the beauty is they allow you to do percentages. So if you say, man, I like, 3 of these or 2 of these or 4 of these, then you can break it down in percentages and have that percentage of the premiums actually be used for those strategies. Okay, and you can see that some of those strategies would be maybe you like the European market, right? And you want to mirror it towards that. Great. Another strategy could be for maybe the Asian market, right? The stock market in Asia, that you can mirror that. I like the S&P 500 just because I go back, over 100 years. I can see the track record of the S&P 500, so I have a good idea what to expect. They actually have a new strategy, which is what you're using, which is called the pace setter. And based on the way that it's set up, then the projection is that if we're averaging normally about 9 months out of a year that we're getting credits. Then this is supposed to be averaging, I think it's closer to 10, over 10 months. And then the interest is supposed to be more consistent. So we'll see, right? And if you don't like it, right, and you don't like the way it's performing, we can always change it. But it's a case where that one I felt like was a really good opportunity to give you really strong growth without missing out on any money that would have been there. Okay, so with that being said, just continuing on, I asked, is it possible to lose money in the sub account? No. Okay, it's protected 100%. The only way the money comes out of the sub account is if there's not enough money to fund your life insurance policy, right? So if the cost of insurance is there, I mean, they have to be able to pay their bills, right? And you don't pay enough premium in order for it to pay for the life insurance expenses, and you have money in your sub account, then yes, it will take money from the sub account in order to preserve the life of the policy to keep it in force. But as far as the market tanking and doing weird stuff and any of those types of things, then no, you don't have any risk of loss in the sub account. It is protected. So they say there's a floor, right? There's a ceiling. Okay, so you're only going to get so much interest, but there's also a floor of 0. So you don't have to worry about actually losing any money. Okay, it's not invested directly into the stock market. So one question that you may have, okay, somebody may have, what happens if the insured dies, okay, or if the policy owner dies? So if the policy owner dies, then we have a contingent owner that's set up. So the policy owner dies, the contingent owner takes over. Now the great thing is that the policy owner has control of the policy. The downside is if the contingent policy owner doesn't understand how this policy works, then they may not pay the adequate premiums, right? They may not use it the way that they need to. So that's the reason why I said involve your family in this, so that if by chance, obviously we don't want any of that to happen, but if by chance that were to happen, then you want to make sure that that person that's taking over the policy is prepared to be able to fund it correctly and use it the way that it's supposed to, so they can take the full advantage of it, if that makes sense. Okay, so in that case, again, it would pass to that person. And I mentioned this to you about the first 24 months of the policy, is that if by chance the information was not accurate, then the company by contract has the right to go out at that point and do a full underwriting to determine if on the application, should something have been answered yes, that was answered no, right? And if they find that there was an error, then it will reverse that. Okay, last thing on this page is the level death benefit or increasing death benefit. Okay, so I actually chose the increasing death benefit option for your policy. And if you would like to change that, that's fine. But the reason why I do that is it allows us to max the policy out even more, put more money into it. And what it does is, Lord forbid, whenever, like not if, but when the insured is gone, it could be at 100 years old, then everything that was paid to the policy, everything that was paid in, minus the expense, obviously, but everything that's in the sub account, plus the death benefit that was promised, that's what's going to go to the beneficiary, right? So they're actually going to get more. They're going to get everything that was paid into the sub account, or that's actually in the sub account, plus they're going to get the death benefit that was promised by contract by the life insurance company. So I love that. Okay, so that's what the difference is between level and increasing death benefit, right? So just continuing on, then I'm asking, what's the easiest way for you to keep track of your policy? And this is phenomenal. This is one of the reasons why I love this company. You can write or get business with other life insurance companies. So I have other companies, and other people have other companies that maybe you're curious about. Fine, right? But the reason why I specifically started with National Life is because I like the servicing side of it, right? I like the customer service side of it. I like that they have tools available so that you as the customer can have free access to your account and you feel good using it. And I don't know, it's possible that someone else by now, which I hope that they have by now, has come up with a mobile app to be able to navigate through your policy. But up until the last time I researched, I didn't find any company that had a mobile app like this. Okay, so one way that you can actually access the information to this policy is by downloading the National Life app. Okay, so you're going to need the policy number, the insurer's owner, probably the owner's number, and maybe like a social security number. Okay, they change it from time to time, but you'll see as long as you go through it the way that I'm sharing with you to go through it, then you won't have any problem. So you can access it through the mobile app. You can also access it through the National Life website, which is a really good website. Okay, you can access it there. You can also call me if you have questions, or text or email me. You can also call the company directly. Okay, so that is an option. So you can do that. So when we're looking at setting up this mobile app, then the first thing you want to do is go in and download the app on your phone, right? Either by the Apple Store or the Play Store, depending on what type of phone you have, or tablet. You want to go ahead and download the app. Uh, what you want to do is you want to, before trying to log into the app, you want to first go into the website. So make sure you go into the website first, right? Go into the website first, register your account. So you have to have a registered online account first. So have that registered account online first. Once you have it registered online, now you can actually log into the app, but you won't be able to log into the app without that information. So take the information that you use to register the account, log into the app, and from then you should be able to navigate, right? You should be able to see your documents. Okay, any documents that you have. As of right now, you probably only have access to your policy and maybe the payment transaction. Only been one payment, so you have access to that. But you can request changes to your policy if you want to change the strategy. You want to change the amount of payment that you're making, or the date that you're paying it. You can actually make the payment directly through the app if you want to do that. At the time when you start borrowing and taking money from your policy, you can actually request money through your app, and you can also pay the money back to your app. Okay. So when that time comes, and it really gets, really fun. I'm going to be honest with you. I've been doing this for some years now. I'm trying to think how long it's been. Probably close to 10 years or something like that. So it's a totally different lifestyle. So I can actually go in. As long as I have the money available, I can actually go into my app, press the amount of money that I want to receive. I can either request it by check, okay, or I can have it deposited directly into the bank account that I have chosen. And then within 3 to 5 days, the money is direct deposit into my account. I use it for what I need to use it for. When I'm ready to pay it back, now I can go into the app and I can press the button and say that I want to pay back that loan, right? So there is an interest. There's different ways to take the money. Okay, so we'll talk about that when the time comes. You don't have to worry about that right now. But the beauty is, after year number 10, from year number 11 through the life of the policy, through the end of the policy, then you don't have to worry about interest at all. So if you choose to, you can take an interest-free loan from your policy and keep it out as long as you choose to without paying interest, and then pay it back. Okay, again, that's the reason why I say the storehouse of wealth concept is phenomenal if anyone gets it, because I'm saying to you that this is an active investment account. Now, can you use it for retirement? Absolutely. Can you use it to save for the future for your kids and grandkids? Absolutely, you can do that. But I'm saying that it's beautiful to understand that you can actually have business ideas, projects, right? You can have all these different things, and then you have money that you're intentionally capitalizing. You're building it over years so that when you need it, you can take it without paying any interest, go have it make money, right? Take that principal or that seed that you use, bring it back after you've made a profit, put it back into the policy so it's available to do something else with. It's just amazing, absolutely amazing. Okay, so just again, understanding that that's my idea. It doesn't mean that everyone's idea is that way, but I do want to put it out there. So if it's not your idea now, that it's there for the future if you decide that that's the way that you want to use this policy. So I asked, are there other benefits outside the sub account and the death benefit? Absolutely. And look at this long list, right? I look at it like this treasure chest that most people never open, because you don't know it until you actually look at your contract and realize that you have it. So these are the riders that you have, these additional benefits that you have that you're not paying anything extra for. So they actually give you all of these at no additional charge. Most companies, and I can show you another company, right? If I want to show you that they charge you for all of these, right? But this company, there's riders that you can pay for in addition to these that they will charge you for before, but none of these, right? None of these. So you can take a look at these. I'm not going to go into these in great detail. They're in your contract, and you can see them, but just take a look at some of these things that's there. It's absolutely amazing to see how much you're getting for what you're actually paying into the policy. It's really phenomenal. So just continuing on, okay. I'm asking how, or if you have this question, I'm stating, how do you maximize the full potential of this account? Okay, you should ask that question. I'm saying the number one thing is determine the purpose. What is the purpose for this account? Okay, what is your purpose for having this account set up? And I'm saying that maybe when you initially wanted it, that your goal was one thing, okay? Or for my other people that have had this for years, maybe when they started, their goal was one thing, but then they decided that their goals have switched up. So now they want this policy to function in a different way for a different purpose. That's fine, right? You can do that, but you have to know what it is that your purpose is for this account today, right? Understand that. Once you decide it, whether it's for the death benefits for your loved one, which is fine, right? And you want to max out and make sure they have the maximum amount of money that they can get when you go or when the insured passes, great, right? Make sure that you know that that's your goal. If it's saving for retirement, right? If that's what you're looking to do, and you realize, hey, this has a great potential for me to be able to stack up and save and prepare for the future, for retirement, like let's go do it, right? That could be one of your purposes, and this policy can absolutely do it. This account can definitely do it. If you're saving for a child or grandchild in the future for their future needs, hey, roll with it. That's a beautiful thing, right? Then you can do that here. You can do it and set it up so that when you pass, that they can be the policy owner, right? So make them the contingent policy owner. So whatever's been stored up in the policy, that they automatically able to take advantage of this funded account to do what they need to do with it, right? Obviously, I'm expecting that you train them, right? Again, I said involve your family members. I'm expecting that you should train them and be training them earlier than later, so that when that happens, they're transitioning and they know exactly how to deal with this policy. Also, again, what I'm saying is I suggest using it as an active investment account. So when I say active investment account, it's a case where you're intentionally saying that I'm going to buy a car at some point with the intention I'm going to buy it at the lowest price I can, and I'm going to sell it at the highest retail that someone's willing to buy it at, right? I want to take the difference, which is the profit, and I want to keep that for whatever I want to do with it. Maybe you want to give a portion of it away or all of it away. Maybe you want to use that to be able to take a vacation, all or most of it, or whatever percentage. Maybe, again, you want to use that for your lifestyle to pay off some bills or to do some different things, right? Whatever it is, that's up to you to determine. But the reality is you could take something like that, get involved and be an expert and become a professional trader, right? Trading is a skill. So even if you don't want to do that part-time, you can do it full-time. You can do it part-time. Keep whatever it is you're doing, but become an avid, effective, and efficient trader so that you're looking for valuable things that people like, okay? And you're going to trade it. Or you say, I want to create something. So maybe you need a t-shirt press or some type of machinery or material, right? In order for you to be able to create something and provide that to other people at cost or, for a profit. Now they're able to pay you, right? So now you can fund your business by buying the equipment that you need. Take that money, put it back into your life insurance policy, right? Continue allowing that thing to make you money, and then when you need new equipment or you need to do another deal, another project, great, right? You always have that money to go back to be able to access, and all in the beauty of understanding that it is growing. So you could put that money into your mattress and do the same thing. Anything could be an active investment account. You can use a jar, right, as an active investment account. The reason why I'm suggesting that this should be considered as an active investment account is because it does provide protection that your house is not going to be able to provide, right? That the jar won't be able to provide. And if you have cash in a jar or in under a mattress, right, or in any other place, then it's not going to have the potential to earn interest. Even if you put it into a savings account, right, or a checking account, then it has very little, a small potential of being able to earn interest. So it won't grow at the rate that I think you deserve. So again, I'm saying consider it as an active investment account to put those resources until they're ready to be used for you to be able to increase it yourself. It's active. Passive is something that you give your money to somebody else. They're going to make money on your money and then pay you a little bit back. That's passive investing. You don't have to do anything with that. Active investing, it requires your skill, your expertise, your time, and your effort, so that you're saying, I'm going to make this money make money. Does that make sense? I'm going to make sure that it makes money, and it takes your time and your involvement in order for it to make money. But either way it goes, I'm saying that this account is your account. You have the freedom to use it in whatever way that you choose to use it. Okay, so it is your account. So what else is unique about the way this account is structured? Now, this is something that, if I didn't say anything else, then this should be something that would absolutely seal the deal for anybody. Just this one aspect of what's going on with these policies. And we're going to take a deeper look at that. And I'm going to show you inside your actual contract document where you can find this. So you can see, I'm not just, making something up, but I'm going to show you exactly where you can find it at. And if anybody asks you, you could actually take them into your policy and show them exactly what I'm saying. So one portion of it is that as you're paying into this policy, again, money's growing in the sub account. It should be growing at some point. Then the credits that your policy is receiving, it should match, right, the expense or what it takes to keep that policy in place. That is a wonderful year to know. What year does that happen? What year is it projected that the credits that are coming into the policy should meet the amount that it takes to actually keep the life insurance policy in place, right? Which means if that's the case, then that means you're not paying anything outright anymore, right? The policy's expense-wise is going to pay for itself. So we're going to look at when that happens. Another thing what we should be looking at is that as these credits are building year over year over year, and as you're paying into the policy year over year over year, then there is a bucket of money that has gone into the policy, premiums that have gone into the policy. There's credits that have been accumulating over years inside the policy. What we want to look at is what year does this policy actually pay for itself? Meaning that there are at least the same amount of credits that have come into the policy that I've actually put into the policy, right? Isn't that crazy to think about, right? In that case, why wouldn't everybody have this type of program? When you realize that there's a year that comes that it will pay for itself, right? Literally pay for itself. So what I'm saying to you is that you have the privilege and opportunity to have a policy that will begin to pay you for keeping it, right? That you're not just paying for the death benefit, right, and hoping that you can get something during your life. It's not that situation. You are paying into the policy to a point where once you get to this point, every year from that year moving forward is that the life insurance company literally is paying you to be able to keep the policy. Isn't that crazy, man? It's a business, right? Or it's a part-time job or whatever you want to look at it. It's like, oh my goodness, you mean to tell me that these credits will actually exceed everything I paid into the policy? Absolutely, right? So I'm saying that's a really big deal. So why wouldn't anybody want to have a situation like that? So we're going to look at the contract, and I'm going to show you exactly where that actually happens, okay? So I'm asking you, how do you maximize the potential of this account? And it's only you that can do that. I can't do it. The reality is, I said that there's everything and everybody that's competing for your resources. Everything and everybody, including our kids, are competing for these same dollars. So the reality is that you are choosing to put your money wherever you choose to put your money at. That's your choice, or spending it wherever you want to spend it at. So when you have opportunities where you have raises at work, or additional funds that you weren't aware of, or maybe you saved something and you were expecting to pay money, so you don't have to pay that, so you have extra money that you weren't choosing, that you didn't need to pay, whatever the thing is, right? Or you're putting money into an investment, you say, man, this thing is not working the way I want to. Let me take some of those resources and reallocate them and put it into a different place. I can't make those choices. You know those life events, and you know those choices that you can make. What I'm saying is how you maximize the potential is that you have to decide for yourself, are you looking at purely the death benefit? Okay, so if it is, great, right? So when the opportunity comes, you can increase the premium, which can increase the death benefit, right? And you can say, hey, to me or to a life insurance company, hey, this is what we initially requested as far as a death benefit. I like to increase that, right? Go through the contract process. They do their little underwriting. They decide if they say that the insured, they're willing to take that risk. Great. You can double your death benefit, right? Quadruple it. You can do whatever you want to do with the death benefit. So that's up to you if that's your goal. Okay. So what I'm saying is that if your goal is not just the death benefit, is that if you are looking at being able to use this as an active investment account, as a retirement account, or being able to fund for future needs of your children, is that as you are able to do more, right? Again, I'm telling you that between 80 and 90% of your premium is going into your sub account, right? So it's not a case where in this, framework of looking at it, that we're talking about you paying for any, you're not paying for anything, right? It's a case where you just have more money available to earn interest. And as more money is going to be available for future needs that you and your family are going to have, right? So the way it goes is when I structure this policy is that the death benefit, I'm only taking the minimum amount of death benefit that you need so that we can max out the amount of premium that you want to pay. So I asked you in this scenario, Josh, what's the premium that you're looking to pay, or that you guys either can or want to pay? And then based on the premium that you told me, then I went to go design this storehouse, right? Or design this policy so that it operates in a very efficient way. Okay. So what happens is if you want to go from whatever you're paying right now to try to go up to putting in twice as much or three times the amount of money, now it's not structured for that. So what we want to do is understand that the life insurance company has had to operate in a certain way only because the banking industry doesn't really want to look at the life insurance industry as a competitor. Okay. So for a lot of people, if they understood exactly what goes on inside a life insurance policy, then they would make the decision that I have made, which is to make a strong emphasis on banking with life insurance companies, right? So in order to kind of tailor that down, they pass laws that actually restrict the amount of money that you can put into a life insurance policy so that it won't be viewed as a investment, right? Even though, again, technically it looks a lot like, to me, like an investment, then they don't want it to be viewed as an investment. And that's crazy to think about. So what happens is that we have to increase the death benefit amount in order for it not to be viewed by the IRS as an investment. So if by chance you pay over that amount, it's not a huge deal. It's a big deal, but it's not a huge deal. What happens is that now it's going to be viewed as a traditional investment, right? Like a traditional, IRA or mutual fund. So what happens is annually, then you'd have to pay taxes on the taxable gain. So whatever money that you made annually, then now they're going to expect that you pay money, report and pay money on that money after that, right? So it's going to function like most other traditional investments. I don't see why we should do that, right? So I'm suggesting that when we want to pay more money into the policy, that we stay below that amount, and if we need to, then we request to have the death benefit increase, but only increase up to the amount that we need to be able to put the money in that you desire you want to put in, so that we don't violate that rule and it be viewed like a traditional a traditional investment. Hope that makes sense. And that name is called MEC. It's called a modified endowment account. So we don't want this policy to be viewed as a modified endowment account, because again, it opens up some other taxable situations that technically we don't have to, because right now, here's the beauty of it. You're gonna have money is gonna be growing inside this policy that you don't report. It's not illegal, like the tax people told you. You don't have to file any reports or report on your taxes or anything like that. When you take loans, they don't tax you on loans, so you're going to take the money out and never have to worry about paying taxes on that. You're going to make money. Now you have to report the increase or the gain that you made as far as that profit. So you'll pay taxes on the profit, but you're going to pay your money back, and you're going to keep doing that as often as you like to. And then inside the policy, the money is tax deferred, so you're not paying taxes on it. Okay, the money that's in there is going to earn interest, and then the principal plus the interest is going to earn interest, right, over the course of the policy that you're not going to pay taxes on, right? It's just a beautiful situation when you really understand how this thing works. So I'm saying it's worth it. You know, when you're looking at the underwriting process and the paperwork and the patience of putting it together, all of those types of things, like the money that you could be putting somewhere else that you decide to put into the policy, I'm saying it's worth it. Absolutely. I believe it's the one of the most effective and efficient places to be able to place your money at, right? If we're using it right. So what I want to make sure that you know is, and my goal is, I'm here to serve you, right? I really want you to understand that there's a number of things that I do have the ability to be able to do. I realize I'm not going to be able to do them all, but if you have questions about, say, your home insurance, other types of insurance, health insurance, those types of things, I still have my licenses. I'm licensed in property and casualty. I'm licensed in health insurance, right? Have experience with all those types of things, so I can absolutely advise you and help you through trying to figure out what's good for you. Maybe suggesting some different companies and things like that. I can do that. So make sure that you keep me in mind if you would like for me to do that. I do have access to these contracts, okay, these partnerships I have with these companies, so I can write any type of whole life policy you think about, right? I don't talk about it, but absolutely. So if you know somebody that wants it or needs it, or you yourself are interested for whatever reason, I can actually do that. I can help you or help an individual. I'm licensed to help with whole life, with term life, okay, with universal life, with accidental and disability, right? I can do it, right? So keep me in mind if I can help in those areas, not just to help you buy it, but maybe advise, right, and counsel and talk through some of that. Also, some estate planning assistance. Now, a lawyer is the one who legally is supposed to be the one to set up an estate plan. So I can't set up an estate plan, but I can provide assistance for estate planning, right? I make sure I say that. So I have a couple of different options of being able to do that. So I know, I believe from what I've heard that you don't have a will and a trust and or a trust set up. So we can absolutely make sure that we get you linked up so that we can go through the process and making sure that happens, and also making sure that that information is updated every single year. We can do that. I really am huge and most excited about the wealth training, right? So that component of what I do, I believe, is the biggest service that I have. Everybody cannot get a life insurance policy. Everybody cannot get an index universal life insurance policy, but everybody absolutely can enroll and be instructed in this wealth curriculum, right? And this training, as far as being able to mature and advance and increase in your financial literacy and your wealth literacy. So I get excited about that. So if I send you something, I ask that you just hear it out. If you just are curious about what's available and what I have, I can send it to you upon request. And again, this active investment or retirement account designing, okay, that you're looking at, that's what this is. That's why I'm there for you, for friends, for family members, for coworkers, for anyone that's looking for me to be able to provide assistance in those areas. So with that being said, I'm going to spend probably like less than 5 minutes, which is funny to think about. We're doing a policy review, and I'm actually going to spend probably less than 5 minutes actually looking at the policy itself. Uh, but the reality is, again, I want to make sure that you're getting the most out of this, and I believe that this is the way that you can get the most out of it. So, with that being said, when you pull up this policy, and it's probably by email, I don't know if they sent you the paper copy of it. I think they were trying to get away from that. What they found is, for a lot of people, they were leaning more towards the electronic copy of it. It's possible that you did get a paper copy. I know that you can have one if you would like to have one. So if you want to request one and you haven't received it, then you can go ahead and let me know. I can request that for you. But when you pull this thing up, again, you can see here it's actually shows 192 pages, right? A lot of pages. So I'm not asking that you read all of that all at once. So again, my goal is just to touch on what it is I think is most important. We're going to review this annually anyways, possibly twice a year, even possibly quarterly, right? Depending on how involved that you are as far as dealing with your strategies and investing money, that type of thing. It could be every quarter, right, that we meet. But it's the case where worst case scenario is every year. So don't feel like you have to get all of this all at one time. The goal is there should be a lifelong contract. This contract should be in place until. So we want to make sure that we understand that. But I do want you to have a really good start at least to understand that this is a very valuable thing that you've done, right? And you did make a very good decision by choosing to put this in place for your family. So I want to make sure that I'm very transparent and candid about that so you can understand the value of this. Okay. So I talked about the amount of money that you're scheduled to pay. As of right now, for this policy, it is scheduled to pay $300 per month. Okay. And you'll see, how that works out. We'll break a few details down. Based on that $300 per month, then the life insurance company is willing to give you guys $140,260 of life insurance. So Lord forbids something were to happen, then this is what pays out tax free. So if this were to happen in month number one, as long as the full underwriting went through and they found that everything was good, then this is what they pay out. They pay this out to the beneficiary, and it's amazing to think paying $300 and getting $140,000. It's a huge risk for the life insurance company, but that's the way that it goes, and that's the reason why the underwriting is the way that it is. So you also have these other living benefits that most people don't know anything about. Okay, so as the cash is accumulating, now you can actually take loans. So it's showing you here at Myles's age 69, the projection is that Myles should have about 1.2, close to $1.3 million available. Okay, not to go spend and trick off. But at that point, you should be able to be very savvy in how to use money. So it should be seed, should be only viewed as seed so that you can actually fund projects for you, fund projects for your children, fund projects for your grandchildren, fund projects for other people. So you'd have that amount of money that's available to be able to fund projects. Okay. Same thing at age 74, age 79. You can see at age 84 that the cash value is projected to exceed $3.3 million. So that is what will be accessible. So the beauty of that, what I said to you, is the way we had this thing structured, is that this 3.3 or close to $3.4 million, if this was the year that Myles were to leave, then his family will receive this plus the death benefit, right? You see that? So it's just a beautiful thing to see how this thing will work. And I love it. Okay. And the last component of it is, if by chance that during the life of the insured, that any of these things were needed, then this is what will pay out. You see terminal illness, chronic illness, critical, illness, Alzheimer's disease benefit, right? You got all of that. I'm believing that none of this is ever going to be anything that you're going to need to use, right? But the beauty is that these things do happen to some people. I'm saying they won't happen to you, but to some people. So in that case, I'm saying I believe that all of those people in that time of need would have loved to have access to these resources, right? So you can look into that more in detail. So I'm going to skim down, go down to actually, I believe, page number 8, and just touch on that, and then touch on one other page. So I talked about the opportunity to be able to have access to these resources if you need to. So what it actually shows us here is there's a few ways that you can actually access the resources. So you can either have a participating variable loan, okay, which goes up and down if you access the money by loan, or you can have a standard loan, which a standard loan is more or less a free loan. It's a wash loan is what it's called. So it means that the amount that you actually borrow, they're going to credit an interest rate or charge an interest rate, but that money is actually going to be in an account that's actually going to earn the same interest rate. So really overall, that you're only paying like 0.5% interest or something like that, right? So it's a wash loan that is nearly no cost. Okay, there is a interest, but nearly no cost. You see here is 0.5%. You see that, and then the last one, okay, it's a fixed loan that you could possibly take. So you could actually take it at that rate. Either way it goes, then you can decide which way you like to take the money. At that time, we'll talk more about it once the money becomes available, and what I'm suggesting, the way that you should probably take the loan. But either way it goes, after year number 10, then in year number 11, you can see that there, then from that until then, you can take a 0% loan. So you won't have to worry about it if you choose to. Again, you could take the loan in whatever way you choose. But after year number 10, beginning in year number 11, then you can actually take that loan and you don't have to worry about paying interest. I advise you to pay the money back, right? Because what happens is if the money's not paid back when the insured dies, then what happens is the beneficiary, whoever the beneficiary is going to get whatever the proceeds are minus the loan. So minus whatever you didn't pay, and if there was interest, minus that in the interest. And it's okay, you know, it's okay. But I would have to say, just for the way that the policy should function, that we're taking loans only to the amount that we know that we're going to pay back. Okay, just to make sure that everything functions the way it should, and we're maximizing the use of this policy. Okay, so going down here to this page, I believe it's page number 9. Here's what I want you to be able to see. Okay, this guideline level premium amount, this is what I base the premium on. So based on the amount of money that you said that you wanted to put into the policy, then that's called the guideline premium. So it shows me that on a schedule, this is the amount that I can actually put in there. So if I take that 3,885 and divide it by 12, then what I came up with is $323, $323.75. So it gave me right at the amount. I'm really close to that $300 with a little bit of room to spare. So as long as you're paying $300 in a month, then you never have to worry about it going over the MEC. If there is a case where maybe in some months you have a little bit more money to put in, or you don't take full advantage of that in the first, few years, then the beauty is you have that little extra amount that you could have paid in, but you didn't. So now you can put that in a lump sum if you want to, or you can increase your monthly payment, for the amount of months until, it gets to the point where you have to stop. If you have a single amount of money, a lump sum of money that you want to put into the policy, then the way they view it is if you put $2,100 or $21,000 into the policy in a lump sum, is that they still would not view it as a MEC. So what would happen is if you put that into the policy in a lump sum, you wouldn't be able to put any more money into the policy for 7 years, right? And they have this 7-year window, which determines this MEC limit. Okay, so you put the $21,000 in, then after that they'll tell you when is the next time that you can actually put money in it. But the beauty is you can do it if you want to do that lump sum. Absolutely, they allow you to do it up until that amount without it being viewed as a MEC. This is a case where if you wanted to express this amount instead of paying $300, then you could pay $5,885 in a year without it being viewed as a MEC, and it's going to do the same thing. So based on that 7-year window, it's going to adjust for the next 6 years how much money that you can put into the policy for the next 6 years. But in 1 year, if you wanted to, then you could go ahead and put up to this amount of money, and it's just going to make that adjustment. So I want to make sure you're aware of that. So the minimum amount that has to be paid as of right now, this number changes annually. Okay, it goes up incrementally, small amounts every year, but it's a case where you have to pay, okay, or the money has to be in the policy to be paid. At least $33 is actually $32.48 per month. Okay, so you're paying $300, right? It only requires right around $32.50 in order to keep the policy in place. So remember, everything above that $32.48 is going into the sub account. Okay, so I want to make sure I'm crystal clear about that. This is what's called the death benefit protection. So what they say is, as long as you are paying at least $514.44 a month. Okay, now that's not a month, that's a year. So 514, 44. Then that's $42.87, close to $43. So as long as you're paying $43 a month, they're saying the policy is not going to lapse no matter what, right? For 10 years. They give you a 10-year guarantee that as long as you're paying $43 per month, that the policy is not going to lapse, okay? So it's a beautiful thing to be able to understand that. So let me go all the way down. Are there other things that we can look at? Absolutely. Again, in here, they give you a breakdown of all the terminology. They give you a breakdown of how everything works. And I may have to actually go to my view. My view. Yeah, yours. So the illustration that I actually sent you, it has it in there. Okay. So what I was looking for is a page. If you can look at the illustration that I sent originally to you to start the policy, near the bottom of that, it has the cost of insurance. It actually shows you the projection. It tells you exactly year by year how much the insurance costs every single year for the life of the policy. In that, you'll see a separate category that has the credit amounts. Okay. So in that category shows you the projected credits that you should receive over the life of the policy. So when I looked at it, then the amazing thing is that right around, I think it's year number 7 or 8, one of those two, somewhere around 7 or 8, then for Myles's policy, then his credits should be meeting or exceeding the cost that it takes to keep the policy in place. That's the number I was saying you look at. That's amazing to see that. So start right around year 7 or 8. And then even better than that, once you look at everything that's been paid into the policy and the expected or projected credits that are going to go into the policy, then you'll see that what has happened is that I believe, I got to get the number, but I know it's at least year 15. Okay. So somewhere around year number 15 is that the policy will begin to pay for itself. So say I'm off. Okay. And maybe it's year number 20. Okay. The reality is that within 20 years that the policy could have credits or proceeds pay into it that will more than pay for everything that you paid into the policy, so that from that moment forward, that now it's all profit, right? All gain from that moment until, right? Again, if Myles lives to be 100 years old, imagine how much more the gain is. Imagine how much more the gain is, because from that moment, right, the policy is beginning to pay for itself. So one last thing as I'm closing, then what I want to make sure that I'm closing with is this, is that when we're dealing with this, again, index universal life insurance policy, I want to be very transparent and upfront about as much as I can. If I don't know it, I can't tell you. But if it is a case I'm aware of it, then I want to make sure that I'm making you aware of it. So the way that this policy has been structured, then again, I said it's a renewable term life insurance policy, so that every year it incrementally goes up as far as the cost that it takes to actually keep the life insurance in place. So for people that have heard anything about universal life, if there's any bad thing that anybody could say, then that's the thing they say. They say, well, you look at it in a year, 40, that the policy is going to lapse. It's not going to be enough money to be able to pay for the life insurance policy, right? Absolutely. If it's structured wrong, that could happen. Okay. So this is what we've done to make sure that you understand exactly what's going on. So even if you don't do this and the policy is safe, but I'm suggesting that at the point where the cost of insurance begins to increase dramatically to the point where it looks like maybe 1 year, maybe it's like $1,000. And then for whatever reason, then the second year, it looks like the cost of insurance, because of the age and the risk, is going to double. And then from 1 year, it goes from 1,000 to 2,000, is going to double. Then at that point, no big deal, right? Doing policy reviews, or you should keep an eye on the policy. Lord knows Myles is 19. When he's at age, 60 or 70, I probably won't be around, to be honest. But there will be another agent that's available. There'll be a life insurance company that's available. And at that point, then I'm suggesting that Myles is asking for the policy death benefit to be decreased only to the amount that he has to have, right? And that at that point, then it's called being what? Self-insured. That means that the amount that's going to be paid out is going to be very close to the cash value that's actually in the policy. So it's self-insured. So the life insurance company really is not on the hook for any money, because now they're only paying out the cash value inside the policy. Why will we do that? We would do that because now it brings the cost of insurance down very minimum, but the cash and cash value inside the policy continues to grow at the same rate. Actually grows at a faster rate, to be honest with you. Why? Because the premiums have been paid in. Less of the premiums that's being paid in is going to be used to pay for life insurance, which means that more money would actually go into the sub account, which means that there's going to be more money is going to operate actually more efficiently at that time, because it's going to be more cash, less cost of insurance, right? So I want to make sure I'm honest about that. And again, that is something that I would suggest happens, but we're talking about, again, that's when Myles is in his 60s, maybe later than that before we'd even have to consider that. So with that being said, thank you for your time. Thank you for listening to this and considering this. Again, you made a very, very good decision. I hope that you were making some either mental notes or pen notes as far as questions, concerns that you have, you can email those to me, you can text those to me, you can call me, right? Or we can schedule a meeting, either face to face, online, or over the phone, right? So we can get those things hashed out. But as of right now, with this policy, there's nothing else to do. If you are happy with the amount that you're putting in, continue to do that. As far as the strategy, I believe it's a really good strategy that we're using to be able to earn credits every single month when that time comes. You'll receive your anniversary date. Actually, should be January the 14th of 2024, right? So a year from the date that the policy was issued is when you get the documents for the anniversary date, and then they're going to get this welcome or congratulation, letting you know that your policy is now able to or eligible to be able to earn credits, right? Again, which is exciting. They don't give you a notification as far as when your funds are available, when the money exceeds the surrender amount. That's something that you have to monitor and I have to monitor, because they don't actually give you any notification about that. But when that kind of time comes, that's the next most exciting time, because now from that moment forward, you know that everything that you're adding to it is just going to increase the amount that you actually have access to do the things that you and your family feel like are best for you, right? Whatever those things are, that you'll have those available for you. So with that being said, thank you. And again, you don't know this, but I have to make sure I say it. But my goal is to help you retire into God's unique purpose full time, right? I would love for that to happen. You may have many other goals that you have, but just being able to help you to get to a place where you're doing only what it is that your purpose to do full time, whatever that is, right? Whatever you have it on your heart to do. But if I can help you get in a position to do that, and that's your desire, then that's what I'm here for, is to help you do that. So thank you for your time. Have a great day.